Brokers Digest, a webcast series by The Edge Singapore, discovering market opportunities with you. This episode is sponsored by Phillip Futures.
Hello and welcome back to another episode of The Edge Singapore's Brokers Digest with me, Amala Balakrishna. In today's episode, we are going to talk about the latest buzz, how to grow your money by constructing your own portfolio. Growing up, I remember hearing that the best way to grow money and to beat inflation rates was to put money into a fixed deposit or buy an insurance savings plan because they offered slightly higher returns than the 0.05% per annum that regular savings accounts with banks were giving. Today, things have been changing. Finance experts caution that not investing is the biggest risk that one can take. Many have been turning to robo-advisors like Scythe, Stashaway, and Endow Us to grow their money. They seem to be giving better returns as compared to the regular savings plans, as we see in the picture showing data collected by colleagues from The Edge. Joining me to talk about how we can all grow our money is Mooris Tjioe, an analyst with Phillip Futures. Hi, Mooris. Happy to have you with us today.
Hey, Amala. Glad to be back.
Okay. So, Mooris, have you been investing in robo-advisors yourself?
Definitely been browsing the plans. I think the marketing campaigns have been going pretty strong. There's a lot more I would say there's a lot better investor knowledge right now than there was a year ago, 2 years ago. What fees they charge, what they invest in, the underlying, what kind of strategies they employ. And with the recent market going, it's forming a perfect kind of up, down. A lot more people are getting very inadvertently invested in their own investments, so to speak, even though they use a robo-advisor. So it's been pretty exciting. And yeah, I've been dabbling in it myself.
So actually, talking about robo-advisors, one thing that stands out for me is that many of them actually invest heavily in ETFs. So to our viewers, an ETF involves a collection of securities, such as stocks, and often tracks an underlying index. So Mooris, what characteristics of an ETF or exchange-traded fund would you say make them very attractive?
I'll say first and foremost, they have developed a lot better than say 5 or 6 years ago. So a lot of initial concerns over things like low liquidity or what kind of impact they have on the underlying, those are kind of by the wayside currently. Whether they resurface, that's another matter. But it's a very simplified sort of instrument in a way. It's during trading hours, you can trade it during trading hours. And what it does for you, I think if I were to summarize in a sentence, right, is, for some of us, we know the concept of diversification and how it can really help in a portfolio. If you use an ETF more often than not, what it does is actually gives you diversified exposure instantly to a basket of whatever the ETF is tracking. For example, if it's tracking a certain kind of equity or commodity, then it's diversified instantly. So you don't have to go out and do it yourself. So I think that's the biggest advantage of ETFs in that sense.
So actually, like you said, Mooris, there are so many different kinds of ETFs in the markets these days. I guess the good news for investors is that there's something for everyone to choose from based on his or her interests or familiarity with a particular sector. But then again, I guess there's also a challenge in terms of deciphering which ETF presents the best opportunities or is the most investment worthy, if I can use that term. Yeah. So what 3 factors would you say investors should look out for when deciding which ETF to buy?
I'll say to begin with, looking at ETFs, firstly, you got to understand that, I think it's easily understood rather, that a lot of people would know there are different kinds of ETFs. So there's your equities, your commodities, your fixed income, which is your bonds, right? And some of them are actually a blend of each. So you're not talking about pure equities, you're talking about, they depending on the strategy they use. So some of the distinctions, firstly, is your categories of your ETF. The other one is perhaps whether it's actively or passively managed, right? And the third is maybe what kind of exposure does it give you inside the asset class. For equities, not all of them are the same. They can be split by a category, investing strategy, and the investing strategy can be active or passive. So we can go through some examples later, and it can be split by geography as well. So you don't necessarily have to have a US domiciled ETF actually tracking US related kind of trends, you see. So I think one thing that's been quite remarkable recently is, and it's quite timely to talk about this, is that ETFs asset under management, you're talking about flows, has actually been exploding. ETF industry itself, I think for people who are new to it, there are some features of it, other than the picking of it, that they should be aware of. I mean, a good place to start is actually that to understand that the ETF industry is kind of concentrated near the top, especially for equities. You're looking at what we call the big three. I think Singaporeans are used to big four, big three in a lot of different industries. No difference to ETFs. So you're looking at iShares, Vanguard, State Street, which is BlackRock for iShares, right? So you especially the famous Q series of ETFs. If you just search ETF Q, you can see there's a whole range of Q series ETFs for all sorts of different investment objectives. So these ETFs have exploded a lot in popularity because I think during the downturn in 2020, right, they proved to be a decently good instrument, and they allowed kind of like an orderly market exit. So it kind of went through their crucible in the sell-off in February and March 2020. So after that, people realized that, hey, actually it's a pretty good instrument to get exposure, instant exposure, in and out, whenever they feel the wind's blowing. For example, I think growth stocks are doing all the well all the way from March 2020 to November 2020 when Pfizer announced the vaccine, successful vaccine trials rather. So during that period of time, then growth stocks, because the Fed's doing their money printing, so-called. And then after that, when Pfizer announced the vaccine, what happened is you see people go into cyclicals. And what you don't want to do is you don't want to suddenly have to sell like 100 holdings you have in 100 different stocks, right? So all you do is you just do it for one ETF. You can have same amount of money, but you do it for one ETF. It's much simpler to manage, especially for smaller investors. And I think this is one thing that people should at least be aware of, what ETFs can do for them in that sense.
I mean, it's quite remarkable that this one instrument has so many benefits that it can bring about for investors. Mooris, you mentioned certain ETFs like Vanguard series and iShares. Maybe you could tell us a bit more about that.
Right. So those they are sort of thought of and kind of issued by these companies, right? Most of them, I would say, they do passive tracking. So for the benefit of anyone who wouldn't know, passive tracking, all they do is they hope to, or rather they do their best effort to mirror the results of an underlying. So for example, everyone knows the S&P 500 or say the STI, for instance, right? The Straits Times Index, the Singapore benchmark. You can't invest in it, right? You can't say, I'm going to buy the S&P 500. What people usually mean is, I mean to buy the SPDR SPY, the SPY ETF. That's the ticker, right? SPY. So that's what they usually mean. So for those kind of scenarios where, you want to do index investing, you don't want to think so much like is clean energy going to come up? Is healthcare going to come up? Is tech going to come up? I just want something broad. Those big three, they offer you more than enough instruments to actually satisfy that kind of coverage. Yeah, and it's pretty interesting industry in the sense that I would say they are very competitive when it comes to fees that they charge. Vanguard, for instance, is I think decently known for driving down price, what we call your expense ratios for the fee for the funds, which means that how much they charge you in a year to actually have a position in the fund, and is you're talking about as low as 0.3 basis points, right? It's I mean, it's pretty negligible compared to a lot of other instruments you can buy out there.
Yeah, I think over here we have a chart that shows us the fees that can make a large difference over time, and you just shared about the fees that Vanguard, for instance, is earning. So that's quite an interesting point, actually, and I'm not sure that's something that investors actually take note of.
I mean, I'll be upfront with you. When I was compiling this data, it's always been in the back of my mind, but when I had a look at the numbers personally, I think I may have a bit of rearranging to do, at least in my head, of the cost benefit. Because in a way, I mean, just to bring you through the slide, for instance, that I prepared, barring any calculation errors, really, if there are any, please forgive me, but barring any calculation errors, we can assume that, reasonable investment plan for, say, someone younger than me, slightly younger than me at least. You start off with 10,000, you put in a bit of money every month, and then after that you assume a rate of return to project how much, right? Based on that assumption, right, if you were to buy into the top 10 ETFs which are the lowest. They have the lowest fees. So the further away you go in terms of assets under management, generally they charge higher fees. So the cheapest ETFs are actually the largest in the market as well. And those are the ones tracking the S&P 500, the entire stock market. There's an index for that. We can talk about it later. So, if you get that kind of exposure and you look at the track record, keeping in mind that past track record of the stock market doesn't mean in the future it's going to go up. You're looking at an average of 10 to 13% per year. Based on that kind of calculations, right, these are the kind of fees that you'll be expected to pay to, starting from the left, if you invest in the top 10 ETFs, the top 100 ETFs, and then after that, at least what is usually stated for, if you use a robo-advisory service, how much they charge in management fees per year. So there's a very big difference in fees. I'm not saying, one is better than another. Of course, all of these are for different objectives. One of it, maybe you want to be more nimble. You don't want to keep thinking like, now maybe it's a bear market, a multi-year bear market, then I have to sell, then I have to buy another one. You don't want to do that. So you give it to another proper advisor to do it for you, right? So it depends on the investment objectives. But I think this one is quite clear that, if there are funds out there that use ETFs as a vehicle for their investment, you have access to the same kind of instruments as well. So I think, bears thinking that, sometimes people, they're not happy, or rather they differ in terms of, I don't think we should have exposure to this. I think emerging markets without China is better than emerging markets with China. So if you want that kind of customizability, I would say that, you should seriously consider learning how to invest in ETFs yourself.
Very, very good advice that you've given. I think that the customizability is something that is important, especially in a time when so many things are happening in the world. And I guess it's also important for investors to read up and have good knowledge in different industries and different geographies and what's happening there, so that they can make more informed decisions. So maybe we can just touch back a bit on this slide over here that we have on how ETFs can help investors help with investor bias.
Right. So I think something interesting is that, so here I'm talking about very specific kind of ETF. So this is not talking about all ETFs, right? There are some ETFs out there that they don't track an index. They don't track an underlying, for instance, right? They have a strategy. So strategies can be active. Very famous one is ARK Invest, right? They do research, they go out, they do interviews, they ask around, they form a plan, and then they, really using their own brain power, kind of, right? They kind of say that, okay, I think this is going to be a big play. That's actively managed. Passively managed means maybe if you set some parameters. For instance, if I come up with one straight away, is every stock that doubles, I trim it by 50%, for instance, that kind of thing, which is quite a common thing for people to do. So there's a lot of this kind of rules-based ETFs, as we can call it, right? So for instance, I think this interesting piece of research in a white paper done for the index, the index being, the ETF rather being QQQA, I think it's pretty interesting. Investor bias, I think there was one piece of investor bias in the white paper that stood out to me. And it's that people tend to cut short their winners because they don't have the conviction. Let's say if your stock doubles and then you don't feel like, is it going to triple? I should just, take my profits and go, because is it really going to triple? But what this chart shows, right? And I think in the past year's bull market, people can believe that there are stocks that can actually do 5 times, 6 times, 10 times even. So the thing is, the average investor, I'm not saying everyone's like that, but average investor, more often than not, they don't really have that kind of conviction. ETFs with this kind of rules-based so-called strategy, right, can overcome that. And this is just one example. So I'm not saying that this is like the best example out there. But if you recognize that you as an investor have certain biases, right, then I think you can really think about using ETFs to overcome these biases, rather than every day you're checking your portfolio. Am I making the right decision? Am I not? Am I? So it's useful in a way. I'll say again, the caveat, it's a tool. It's not everyone must do it. It's if you recognize certain features of your own investing journey that this can help with, then this is a kind of a pretty good tool for you to explore.
Something that's very useful to me personally, that of what you mentioned, Mooris, is that you don't have to keep checking, and then you eliminate that bias. And a question that we have been receiving so much is about China. What are the sectors to invest in China? Is there any particular ETF that helps you to invest and get better returns in what is happening in China? We also hear that people are saying that technology stocks. Some say that they are doing better. Some say that it's an industry to avoid. So, is there any particular kind of ETF strategy that you would suggest? We see here there's the CraneShares CSI China Internet Fund that we have over here. So maybe could you tell us a bit more about this?
Right. So when it comes to this particular ticker, right, I think it's one of the more well-known ones among especially the younger investing community in Singapore. So its constituents, it holds, say, your major Chinese internet companies. You take your pick, you just all of them basically. So this, I think, has broken quite a few hearts in recent months, obviously from the chart. So I'm not going to go into where I think the chart's going to go in the coming days. But of course, more lucid kind of sober analysis of this is firstly, I have here things like expense ratios, right? So expense ratio, you're talking about, this is an ETF with an expense ratio, which means how much they charge you per year, which is approaching that of, say, advisors themselves. So that's for people to take note of, at least. But I think what is happening in China, instead of, say, so if I were to summarize what's happening in China, you're looking at a regulatory crackdown on certain excesses, let's call it that, right? You're talking about your over-leveraged, kind of over-risked economy, if you like. So you start with that, and then you see those kind of industries that are suffering. Your consumer discretionary, tech, healthcare, those are really suffering, right? So that's on the way down, so-called. I don't know whether it's going to come back up. But you look at what's happened otherwise. In the middle of the year, the Chinese 5-year plan that will call for kind of like renewable energy expansion, let's call it that, right, for the next 5 years. And you can actually see that the ETFs that track renewable energy, some of them are not that easy to access if you're here from Singapore, I feel. But the point to be made is these ETFs do give you kind of a simplified view. Say, hey, there's a tech crackdown, therefore tech ETF goes down. Hey, the Chinese leadership said that they're going to invest more in clean blue skies, clean energy, less emissions. ETFs tracking a basket of securities, stocks, bonds, anything that actually has to do with clean energy is on its way up. So, rather than having this headache over, if I buy this particular stock, is the leadership reliable? Are they expanding in the right things? Do they have supply chain risks, things like that? You're instantly diversified. Again, it's not devoid of risks. There are still risks. It's up to you to have a look at them. But it gives you this kind of like, you can see where the trend is going. And I think the trends here are quite clear if you look at the divergence in these two ETFs. So that's for the Chinese side. I think the real beauty of these is, it kind of gives you a decently simplified at one glance view of, do you want to jump on these kind of trends? And no one's to say that if you don't want to use an ETF, right, you can't just, you could totally just look in the constituents on the ETF and assess those companies or securities yourself, right? So, you could totally do those things.
Yep, that's very true, Mooris. So I think another thing about ETFs that I think is very interesting is that it allows you to get into the industry of gold and commodities. So maybe would you say that using an ETF for these sectors is something that is advisable?
I would say so perhaps if you talk about one of the more popular gold ETFs, as for that proxy for that discussion rather, right? You're looking at, most of them are passively managed, so really it just tracks the price of gold, right? A lot of people do use it for very quick and easy entry and exit into gold prices. So what you can really observe, I didn't plot a chart for it, but you can see that during periods of, say, turmoil in stock markets, dollar weakness, or any flavor of Federal Reserve minutes you like every month, you're going to see a reaction when it comes to the gold ETF, because gold prices are moving as well. So it's a lot easier to get exposure using something like this. And the happy thing, if you are into that kind of investing, is that this is one of the more traded ETFs in that sense, so the liquidity is there. So that concern at least is allayed. As to which direction it's gonna go, or whether gold as an inflation hedge is still kind of relevant, or what other kind of commodities, that one I wouldn't really comment on it, not today at least. But there are ETFs tracking all sorts of commodities, so to say. More popular one that I've been eyeing myself recently is not eyeing as in not buying, but observing. Is water resources. So there are many different kinds. There's one which is a global water Invesco one, if I'm not mistaken. Global water ETF. Then another one is tracking just California's water. Then there's others which tracks a proxy of water, which means a farmlands, which it just depends on how far down the rabbit hole you want to go. But yeah, there's there are more and more ETFs for every kind of exposure that you kind of want. Of course, don't go too far down, especially if you're starting out. I mean, do you really need such detailed exposure? More often than not, I must reiterate that I think people do tend to pick based on emotions. They like something, they stay with it, whether it performs well, whether there's any basis behind it or not. I think sometimes, unfortunately, there isn't. So people have to be quite sober about it. There are a lot of different kind of ETFs that you can diversify into, right? But do you really need them? That's a topic they need to think about themselves.
Very true. So Mooris, I think just now when you were sharing, what I got was that there are correlations between ETFs. So, and I hear that increasingly people are suggesting that it's important to find these correlations. So would you recommend this practice?
I mean, short of taking a course yourself in portfolio management, which I definitely need to do as well. The very basic kind of interpretation for some of these things, right, is there are a lot of tools out there to actually let you inspect, if you like, the correlation between different securities, right? So if you look at I have here on the slide just handpicked, so-called. I don't use the word handpicked to make it sound nicer. It's just literally what was on my mind at the time. Just to illustrate an example. So I'm not saying this is a good basket of ETFs or anything, because you still haven't worked out what kind of exposure you want in terms of portfolio weightage, right? But how do you read something like this, right? If you look at a green circle, which is the number which is close to 1. So that means that your two securities actually move kind of in tandem with each other. The closer to 1 it is, the more perfect that relationship. If it's red, then you're looking at something that's negative, which means it moves opposite from each other. The closer to -1, the more it's like a kind of like a perfect away from each other. So you don't want that either, because your portfolio is not going to go anywhere. But there are kind of correlations which are near 0, which means that the price movements are independent of each other, right? So I'm not saying that there's ideal kind of there are ideal kind of weightages for this, also based on your risk appetite, your investment horizon, so many things, right? But the thing is, if you're looking in your portfolio, you just enter it into something. I have the source here in the slide. If you just enter your portfolio into this kind of track, and you realize that everything is above 0.9 because you've been listening to say Reddit or social media all this while, and then your portfolio is all the momentum stocks, right? Everything is 0.9. I'm not saying it's bad, but it's just that everything's going to go up and everything's going to go down at the same time. If you want to construct a long-term portfolio, at least the old wisdom is that you want something more diversified. And ETFs give you diversified exposure, because the ETF itself is a diversification, of course, unless you buy GLD, right? And after that, you can diversify by looking elsewhere. Something I may highlight to anyone listening in still is, for example, when it comes to emerging market indices, right? Emerging market indices, there are perhaps 2 major kinds, according to my simplification. That is, emerging market indices, many of them include China as well. And I mean, if you've been following the Chinese stock market recently, it's pulled everything down. But there are a lot of indices out there that is emerging market ETF ex China, right? So without China. So maybe you want to look into those kind of exposure as well. So it offers less correlation, so to speak. So I think those are pretty valuable kind of very basic steps to take for your portfolio. Again, this is not, allocate this. I have 1, 2, 3, 4, like say nine securities here, right? I'm not saying that you must split everything as a 11.1%. Please don't do that. But it's just for I mean, not you lah, but in case anybody actually thinks of that. So please don't do that. But you can think about what kind of exposure you want, what kind of risk tolerance you have, and if you're not going to do this kind of ETF portfolio management yourself today, at least have that thought in your head. If not today, maybe sometime in the future. Because I mean, you're talking about really, really low fees, and compounded over time, they do add up. They don't add up because I mean they're so low, right? They don't add up rather. So it's something people should have in their mind at the very least.
So while we're at it, Mooris, are there any pitfalls to investing in ETFs that viewers should bear in mind?
Pitfalls. I would think the first one is that be careful of certain. I'm not saying don't invest in it. Again, trying to be very cautious about these kind of remarks, right? But for instance, when it comes to the more popular ones, Cathy Wood's flagship, which is ARK Innovation, right? I'm not saying if it's good or bad, it's going to go up or down, but just take note of the expense ratio, for instance, right? You're looking at actually a pretty high expense ratio. And based on the chart I talked about at the beginning, you can see how that erodes your returns over time. Of course, I mean, if she delivers the similar 100+% per year, every single year, she can charge whatever she likes. She can charge me 10% expense ratio, I'll gladly pay that, right? But, that's not a guarantee. That's not a guarantee. So it's for people to think about, definitely. That's the first thing that I would kind of advise people to be at least mindful of. Look it up if that hasn't been in your mind yet. Other than that, I would say one thing that really adds to your any strategy out there is to just spend a bit more time just searching what kind of ETFs are there apart from the passive index ones. A lot of passive rules-based ones are really pretty interesting. Think about those for more of yield boosting in a sense. I'll maybe give an example is there are some ETFs out there that they just invest in IPOs, right? And everybody knows what the chart for IPOs, at least some of them, they look like, right? Which is just like, it's just V-shape, kind of W shape. Whether you get caught at the top or at the bottom, nobody knows on the first day, right? But, there are some funds out there. You can have a look at their track record and see whether you want something like that for yield boosting. For something more safe, you're looking at more of like passive index, kind of like something more vanilla. My word's boring. I don't really think it's boring, but it's something along those lines. So there's yield boosting, there's something more defensive. I think you want a mix of that, or at least you want proficiency in, or at least you know what you're investing in when you want to have that kind of exposure. Yeah, so that would be my advice, at least.
There seems to be something for everyone, right? In terms of the spectrum of what industries and geographies an ETF covers.
Hopefully.
So with that, we have come to the end of this week's Brokers Digest. Thank you, Mooris, for sharing your insights and tips with us. To our viewers, we hope these strategies help you in your investment decisions in the short and medium term. For more analysis on the stock market, you can visit the websites of Phillip Futures or The Edge Singapore. Do also check out our Investment 101 article by The Edge Singapore entitled, "This is how much robo-cash accounts are offering you for your cash." Do like us on Facebook and Instagram to be alerted on our next episode. We'll be having an insightful session on cryptocurrencies, which you won't want to miss. You can also leave us a comment below if there are any questions or topics you'd like for us to discuss. Once again, I'm Amala Balakrishna. With me is Mooris Tjioe, and we'll see you again in 2 weeks. Bye.